Today, we're breaking down what wealth distribution in America actually looks like in 2026, who's winning, who's stuck, and why the gap feels bigger than ever. My name is Moore, and I spend way too much time thinking about money psychology, wealth inequality, and why financial systems reward some behaviors and punish others. If you're someone who works hard, does what you're supposed to do, but still feels like wealth keeps slipping further out of reach, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because once you understand how wealth is actually distributed in America right now, a lot of things will finally start to make sense. Here's the thing. Most people think wealth distribution is just about income. Like, if I made more money, I'd be fine. But that's not how this works. Not anymore. Income is what you earn. Wealth is what you keep, grow, and control. And in 2026, the gap between those two things has never been wider. Let me say that again, because it's important. The biggest financial divide in America is no longer between high earners and low earners. It's between people who own appreciating assets and people who don't. That's it. That's the entire game. Let's get concrete. According to data from the Federal Reserve's Survey of Consumer Finances, updated trends through 2025 and early 2026 estimates, the top 10% of Americans own roughly 70% of total U.S. wealth. The top 1% alone owns about 32 to 35%. The bottom 50% of Americans own about 2 to 3% of total wealth. Let that sink in. Half the country owns basically nothing in net terms. Not because they're lazy, not because they're stupid, but because the system rewards ownership, not effort. And this is where it gets really interesting. You'll often hear headlines like, the average American household net worth is over $1 million. And people hear that and think, well, damn, I must be failing. But that number is wildly misleading because averages get pulled up by extreme wealth at the top. The median household, the person exactly in the middle, tells the real story. In 2026, the median American household net worth is roughly $190,000 to $200,000. And even that number has a lot to hide. Because for many households, most of that wealth is home equity they can't easily access, retirement accounts they can't touch without penalties, assets inflated by housing prices they didn't actually choose, liquid wealth, cash, investments, things you can actually use, is far lower, which is why so many people feel rich on paper but stressed in real life. Let's talk about the bottom half of the population, because this is where the disconnect between reality and perception really shows up. The bottom 50% of Americans have a median net worth under $10,000, often have negative net worth due to debt, own virtually no stocks, have little or no access to appreciating assets. And here's the psychological kicker. Most people in this group don't realize they're in it. They think, I'm not poor, I'm just temporarily behind. But wealth distribution doesn't care about optimism, it cares about math. Now, you might be thinking, okay, Moore, but what about the middle class? Here's the uncomfortable truth. The middle class still exists, but it's hollowed out. In 2026, the middle 40% of households own about 25 to 28% of total wealth, are heavily dependent on wages, are extremely sensitive to inflation, layoffs, and interest rates. They're not poor, but they're not secure either. One medical issue, one job loss, one bad financial decision, and everything starts to wobble. That constant pressure, that's not an accident. This is where the math explains everything. Let's compare two households. Household A earns $70,000 a year, saves $5,000 a year, keeps money mostly in cash. Household B earns $70,000 a year, saves $5,000 a year, invested consistently in assets over 10 to 15 years. Same income, same savings rate, wildly different outcomes. Because assets compound, wages don't. And in 2026, asset inflation, especially housing and equities, has massively outpaced wage growth. That's why it feels like you're running uphill on a treadmill. Let's talk about the top 10%, because this group isn't just richer, they play a different game. The top 10% own the vast majority of stocks, own multiple properties, benefit from tax advantages most people never access, can borrow cheaply using assets as collateral. Here's what most people don't realize. The wealthy don't grow wealth by saving. They grow wealth by controlling systems. Debt works for them. Inflation works for them. Market volatility works for them. Meanwhile, everyone else is just trying to survive the swings. This isn't just math, it's psychology. When you don't own assets, you focus on short-term survival. You make conservative decisions. You avoid risk, even smart risk. When you do own assets, you think long-term. You can afford to wait. You can afford to fail. This creates a feedback loop. Wealth creates better decision-making conditions. Poverty creates worse ones. That's why telling people to just invest without context is useless advice. Look, I'll be honest. Hard work still matters, but in 2026, hard work without ownership caps your upside. You can outwork your way into stability. You cannot outwork your way into generational wealth. That requires leverage, and most people are never taught how leverage actually works. Here's a quick reality check. If your net worth is under $10,000, you're in the bottom half. $100,000, you're doing better than most. $500,000, you're solidly upper middle. $1 million, you're in the top 10%. $5 million plus, you're playing an entirely different game. This isn't to shame anyone. It's to replace vague feelings with clarity. Because clarity is empowering. Stop blaming yourself and start playing smarter. You don't need to be in the top 1%. You just need to stop being stuck in the bottom 50%. That's the real goal. The top 10% of Americans own roughly 70% of total U.S. wealth. The top 1% alone owns about 32 to 35%. The bottom 50% of Americans own about 2 to 3% of total wealth. Let that sink in. Half the country owns basically nothing in net terms. Not because they're lazy, not because they're stupid, but because the system rewards ownership, not effort. And this is where it gets really interesting. You'll often hear headlines like, the average American household net worth is over $1 million. And people hear that and think, well, damn, I must be failing. But that number is wildly misleading because averages get pulled up by extreme wealth at the top. The median household, the person exactly in the middle, tells the real story. In 2026, the median American household net worth is roughly $190,000 to $200,000. And even that number has a lot to hide. Because for many households, most of that wealth is home equity they can't easily access, retirement accounts they can't touch without penalties, assets inflated by housing prices they didn't actually choose. Liquid wealth, cash, investments, things you can actually use, is far lower, which is why so many people feel rich on paper but stressed in real life.
The big lie about money. Look, we're taught one main rule growing up. If you just earn more money, everything else works itself out. But that's not what the data shows. According to the Federal Reserve, nearly 1/3 of households earning over $100,000 still live paycheck to paycheck. That should immediately tell you income alone isn't the solution. Here's what most people don't realize. Wealth doesn't grow in a straight line. It grows in levels. And each level has a different enemy. Level 1, Survival Mode, $0 to $10,000 net worth. At this level, money feels fragile. One unexpected expense, a car repair, medical bill, or rent increase, can throw everything off. The Federal Reserve reports that 37% of Americans can't cover a $400 emergency without borrowing. That's not a budgeting problem. That's a stability problem. Psychologically, your brain is in survival mode. When money feels scarce, long-term planning shuts down. You're just trying to make it to the end of the month. Now, you might be thinking, shouldn't I be investing? Not yet. Trying to grow wealth without stability is like trying to sprint on ice. You don't need speed, you need footing. Action step. Build a small emergency fund, $1,000 to $5,000, and eliminate high-interest debt. This level is about control, not growth. Level 2, the stability trap, $10,000 to $100,000 net worth. This is where most Americans get stuck. You're doing fine. You have savings. Maybe a 401k. Bills are covered. But progress feels slow. Here's what most people don't realize. This is where lifestyle creep quietly kills momentum. Every raise gets absorbed. Better apartment. Nicer car. More subscriptions. Let's do simple math. If you invest $1,000 a month at a 7% return, in 10 years about $173,000. In 20 years about $520,000. But according to Dalbar studies, the average investor underperforms the market by 1.5 to 2% per year, mostly because of emotional decisions and inconsistent investing. You're not failing here. You're leaking momentum. Action step. Every raise you get, invest it before upgrading your lifestyle. Automate progress so discipline isn't optional. Level 3, momentum, $100,000 to $500,000 net worth. This is where it gets really interesting. At $100,000, compounding becomes visible. A 7% return now produces $7,000 a year without extra effort. But fear spikes here. Now, you might be thinking, what if I lose it? And that fear causes people to pull back at the exact moment they should stay consistent. Psychologically, this is loss aversion. Your brain treats losing money as more painful than gaining it is rewarding. The irony? The people who stall here are often the ones closest to real financial freedom. Action step. Stop over-tweaking. Staying invested matters more than being perfect. Level 4, financial gravity, $500,000 plus net worth. Very few Americans reach this level. At $500,000, even a modest 5% return generates $25,000 a year. Money starts pulling more money toward it. Time, flexibility, and choice begin to replace stress. Most people never reach this level because it requires patience during boring years. No excitement. No quick wins. Just consistency. Look, if this video helped you see exactly where you are, that's powerful.